Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 5th of February. I'm Daniel Lam, your host for the podcast. Previously, we have characterized the current US economy to be a weak Goldilocks. There's slowdown in growth, but no imminent crash in sight, and inflation is still very much under control and going downwards. Now, there seems to be a turning point for the macro momentum, with the stabilization of global manufacturing. So while developed market composite PMIs have largely moved sideways, manufacturing PMIs have rebounded and returned to expansion since late 2025. The December ISM Manufacturing Report supports this picture. It expanded for the first time in 10 months from stronger production and new orders. Yes, there are caveats. For example, firms are not adding to payrolls as uncertainty remains elevated, while respondents point towards restocking and tariff front-running amid volatile and arbitrary trade policies. But we believe this stabilization in manufacturing suggests that US growth may have bottomed, opening the door to improving growth momentum. Now, markets are driven by the acceleration or deceleration of growth rather than its absolute level, as they respond to marginal changes rather than well-known trends. So this current dynamics helps equities to outperform bonds. Now, what is the Fed likely to be doing about this growth and inflation dynamics? Well, there is such a case that this pickup in manufacturing or better growth environment has got to do with the productivity gain due to the usage of AI, which has 4 times over the last 2 years by estimates in the United States, without a very significant rise in inflation cost. So this is the scenario that Kevin Walsh sees in the economy, and we believe there will be 3 Fed rate cuts at 25 basis points each in 2026. And barring a recessionary scenario, this should support S&P 500 higher, and we have a 12-month target at 7,800. Yes, again, we acknowledge that risky assets have been wobbly in the recent sessions, but investors should stay medium to long-term focused and use these short-term noises as opportunities to be adding to US equities and technology stocks. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.